I look at companies that are attracting and receiving and needing smaller dollars, $2 million, $3 million, $5 million, $10 million investments that are needing that capital to grow, but the investment is coming from China, and it is coming from China. I think it's too late to stop that flow of capital, because no matter how many impediments there are to that flow, being the optimist, I believe that it will seek and find markets in the United States.
I touched earlier on how the funds in China want to tap into early stage investments in Silicon Valley. And the way they do that is to partner up with US-based funds. So they sit on each other's investment committee such that they actually have resources on the ground to get into deal flows. And they tend to choose, I guess, funds that have certain brand name so that it helps them get into deals. So that's on the early stage side of investment, and I think that's a little easier to navigate. The question is, well, when the company gets bigger and then then it gets more and more popular and gets much more competitive, then what do they bring to the table? And naturally, I think a lot of funds that we work with in China, Silicon Valley Bank, we manage a fund of funds practice. We in fact invest into a lot of different funds in China. So we see this play out where funds in China are now raising their own capital here in the US. And they are tagging their brand name on there. They are adding their strategic angle to the investment. So the money is no longer, green in the US, but red in China. So the money is no longer by the color. It's really by who are their LPs, who are the fund's LPs, who invested in that fund, and who can the fund tap to help these later stage companies grow and expand into China and likely into Asia. Because when you're at that stage, what you're looking for is market expansions, maybe US-based companies going to China potentially. So you are looking for additional values. And that's how these funds get by being competitive.